How's it going, everyone? Welcome to the Pip Catcher Expedition. This is episode 3 of the mentorship playlist, and today we're going to be going over market structure, which is the foundations of price. Okay? Now, in market structure, we're going to be going over market structure from basic to intermediate, all the way to advanced market structure in this whole one video. So, make sure you guys get your notebooks, get your journals, and make sure you take notes on this. Because whatever is going to be shown in these slideshows, let alone what these concepts are given to you guys need to know what these are, write it down, pay attention to what I'm showing you, because these are the bases of what you're going to need to learn so that you can eventually use these in the live markets. Okay? Now, what is market structure? Market structure is the result of market reacting in directional manner in one of three types: bullish, bearish, or consolidation, other known as ranging. This will vary depending on multiple factors, such as different highs, lows, internal range liquidity, external range liquidity, displacement, time, and price. So, with the market structure, with one of the three types, bullish means we're going up, bearish means we're going down. Consolidation or ranging means that we're going sideways, either in small ranges or large ranges, which means small movements going sideways or large movements going sideways. Okay? And this will vary depending on multiple factors. So each of these factors will determine and depend on what direction the market will be going in. So looking at all these factors, I want you to write everything down here. Pause the video if you need to. Okay? Now, with market structure, this is not just creating highs or creating lows. There's more to it. So going into depth of this, today you're going to be learning the basics of it. So this is what, like basic market structure, this is what all retail traders should know. All retail traders, whether you trade with indicators, whether you trade support and resistance, whether you trade ICT concepts, you should know what basic market structure is. If you don't, what the fuck are you doing? Okay? So today you're going to be learning from basic to intermediate to advanced market structure. Once you learn basic and then you move on to intermediate, that's when you can start to see a shift in how people trade with retail and then how people trade ICT. And you will be learning how to trade ICT concepts, other known as smart money concepts. Okay? Types of market structure. So in basic market structure, you're going to learn about uptrends, downtrends, and consolidation. In intermediate market structure, you're going to be learning about buy-side liquidity and sell-side liquidity, which is known as external range liquidity. Okay? Advanced market structure. You'll be learning about a breakup structure, other known as a breakup market structure, liquidity sweep, which is also known as a buy-side liquidity sweep or a sell-side liquidity sweep, a market structure shift, which is also known as a shift in market structure. You'll also be learning about short-term lows and short-term highs, intermediate-term lows, intermediate-term highs, long-term lows, and long-term highs. And finally, you will also be learning about inducement and displacement. And we will be starting off with basic market structure. So, basic market structure. An uptrend is when we are having bullish momentum to the upside, also known as bullish order flow. This will form highs known as higher highs. This will form lows known as higher lows. So in an uptrend, when you create highs and lows, the highs that you create are called higher highs. The reason they are called higher highs is because the next high that is formed is higher than the previous high. Same thing with the lows. Every low that is formed, the next low, it should be higher than the previous low. So creating higher highs and higher lows will show bullish momentum, other known as bullish order flow. Order flow is basically how the market is reacting, which direction the market is reacting, or how it's favoring. So in this moment, or in this example, bullish order flow is showing more favoring to go up rather than down or sideways. Okay? And this is a chart example of higher highs, so higher highs, and higher lows here. And these are involving candlesticks. Okay? See, these are candlesticks, a candlestick example on the chart. Now, a downtrend is basically the opposite. So a downtrend is when we have bearish momentum. Remember, bearish means we're going down, right? Downtrend is when we have bearish momentum to the downside, also known as bearish order flow. This will form highs known as lower highs. This will form lows known as lower lows. So instead of creating higher highs and higher lows, we are creating lower highs because the next high that has formed is lower than the previous high. And with the lows, we are creating lower lows because the next low that is formed is lower than the previous low. And this is showing bearish order flow, or the market is favoring to go lower, not higher or sideways, right? This is a chart example with the candlesticks of what a downtrend looks like, creating lower highs and lower lows. And finally, to end off basic market structure, we have consolidation. And consolidation is when the market is basically going sideways, also known as ranging. So when you range or you consolidate, you can either have small ranges or large ranges. Okay? This includes creating equal highs. This includes creating equal lows. Equal highs and lows are known as engineered liquidity and or pools of liquidity to be taken out. So here I am showing you what consolidation looks like. You're basically going sideways, and also you're creating equal highs and equal lows. Equal highs are basically two highs that are formed at the same exact price level. Equal lows are basically lows that are formed around or near at the same exact price levels. You see how these candles pretty much almost line up exactly at the same level. Same thing with these highs. These are known as equal highs and equal lows. Now, I'm going to dissect this from what everybody, other known as retail, what everybody sees this as, compared to what we will see this as. So we are comparing to what retail traders see equal highs and equal lows known as, which is called engineered liquidity, with smart money concepts. So smart money concepts and ICT concepts are the same term. They are just different names. So when I say SMC and then I say ICT, they are the same name. So don't get confused when I say ICT or SMC. It is the same word. It's just a different word for it. It's the same terms, different word. Okay? So don't get confused when I say SMC and ICT like they're both different words, okay? They are the same thing. They are the same term, okay? So, what retail traders, or pretty much 90 to maybe 95% of all traders see this as, is a thing called support and resistance. So support and resistance is a concept that retail traders use to enter trades on. So what they believe is that at highs, so when at old highs and equal highs, specifically equal highs, they believe at specifically equal highs that when the market trades up to these highs, what they believe is that the market is going to trade up to it and then reject lower. And they believe this is called resistance. So the price acts as resistance to trade lower. When market creates equal lows, people see this as support, as market or price is supporting to touch it one more time to reject higher. But the thing about it is the market algorithm and as well market makers. So market makers are basically big entities, the people with a lot of money, or as I like to say, the people with the fuck you money. You know, the money that, you know, people can throw at you and say fuck you. That's what I call fuck you money. So the people that have fuck you money, that's the kind of people that see this as an opportunity to stop retail traders out. So when you ever see equal highs or equal lows, don't think, oh, the market's going to tap into it and then reject higher. Or, oh, the market's going to tap into this and then reject lower. Don't look at that as an opportunity to go short or to go long. When you see this as the market is going to eventually take one of these sides out. And when we take this out, this is going to be known as a liquidity sweep, which we will go over later on. Okay? So, when you see this, retail traders see this as support and resistance. As an ICT trader or an SMC trader, we see this as an opportunity for the market algorithm to trade below or to trade above it. Okay? So we see these as pools of liquidity to be taken out, to be traded below or traded above. Okay? We don't see this as trading opportunities. We see this as liquidity or liquid money sitting there, which is other known as equal highs, equal lows, or engineered liquidity. Okay. Intermediate market structure. So buy-side liquidity is where stop losses and stop orders reside, which are above old highs and equal highs, other known as, like we just discussed, engineered liquidity. The market creating pools of liquidity at highs to be later taken out of the market to then in return stop out retail traders and give market makers the funds needed to go in their intended direction. Buy-side liquidity is a form of external range liquidity. So, there are two types of liquidity when it comes to intermediate market structure. So you have external range liquidity and you have internal range liquidity. External range liquidity will define structure, okay? Internal range liquidity will define a thing called PD raise, which we will go over in another video, okay? So let's focus on structure right now. External range liquidity will be either a high or a low, but known as buy-side liquidity, okay? So buy-side liquidity, so above these highs, buy-side liquidity is where stop losses, so when you hit stops, you get stopped out of a trade, or stop orders. That's when you get tapped into a trade. You get tapped into a buy order, which is called a stop order. They reside above old highs and equal highs, other known as engineered liquidity. But the reason they reside there is because that's where the majority of retail traders have their entries for stop orders, or that's where they have their stop losses. And it's called engineered liquidity because it's the market algorithm building up liquidity on purpose to be taken out later. And also, market makers, so the people with the fuck you money, they see this and see this as an opportunity to add more liquidity to the market. Okay? So when they add more liquidity to the market, liquidity gets added to the market when traders lose a trade. Whenever a trader loses a trade, money gets added to the markets. This is called adding liquidity to the market. When you add liquidity to the market, there is more liquid funds to be moved around. The more liquid funds to be moved around, the more opportunity market makers have for them to take the trade that they desire most. So when market makers see these equal highs formed, they see, oh, okay, the market created engineered liquidity.
At market close, Dow Jones Industrial.
Fucking Siri. Okay. Anyways, so where was I? Okay, so the market algorithm creates engineered liquidity, which are equal highs or old highs. The market will trade above these old highs or equal highs, known as engineered liquidity, to take out their stop losses. This is adding more liquidity to the market. Market makers see this and see this as an opportunity to sell or short here. Once they short here, they are stopping out people whoever were going long here, and they're stopping out people who were already short here. So they're stopping out both sides of the markets so that when they enter the trade, they have extra liquid asset funds inside the market to be pushed lower. So they have whatever money they're putting in on their trade. So like, let's say $10 million plus whatever retail traders that got stopped out. So an extra 1 or 2 million, for example. Okay. So again, buy side liquidity is above old highs or equal highs. And the market algorithm and market makers use this as an opportunity to stop out retail traders. Okay. Sell side liquidity. Sell side liquidity is where stop losses and stop orders reside, which are below old lows and equal lows, also known as engineered liquidity. The market creating pools of liquidity at lows to be later taken out of the market, to then in return stop out retail traders and give the market makers the funds needed to go in their intended direction. Shit, I cannot speak today. But yeah, so take notes, okay? Sell side liquidity is a form of external range liquidity. Okay? So external range liquidity is either a high or a low, other known as sell side and buy side liquidity. Okay? So external range liquidity is either buy side or sell side liquidity, which is a major high or a low, or old highs and old lows. Okay? So same thing like the buy side liquidity, sell side liquidity has engineered liquidity just at the lows. Market makers see this as an opportunity to stop out people who have their stop losses here and have their stop orders here. So they're stopping people who were going long, and then they're stopping people who just went short there. Okay? And then it gives more liquid funds for market makers to use to go and push higher for higher prices. So if they went long here, they're stopping everybody who went short. If whoever went short here, they get stopped out right when the market hits this and then reverses. If they were going long here, they get stopped out because their stop losses are here. So they're taking out the long orders and the stop orders and the short orders. All of those orders get stopped out. They're getting manipulated by market makers to then get stopped out, adding more liquidity to the market. So then that extra liquidity, market makers use that as an opportunity to push for higher prices. Okay? Advanced market structure. So a buy-side liquidity sweep, also known as, I cannot speak today, I'm so sorry, but a buy-side liquidity sweep, also known as a BSLS, is where the market trades above old highs and or equal highs with failed displacement to then reject in the opposite direction. This is showing market makers manipulating retail traders into getting stopped out and then getting added liquidity to the market. Sweeping buy side can also indicate where the draw on liquidity is going to be. So, we got a lot to talk about here. So, we are in an advanced market structure, and this is the market structure that you are going to be using pretty much every time you trade. Every time you trade, this is going to be the market structure that you are going to be using from now all the way to whenever you stop trading. You're going to be using this market structure. Okay? So, let's go over the first thing. This is where the market trades above old highs and or equal highs with failed displacement to then reject in the opposite direction. So again, when we talked about buy-side liquidity sits above old highs and or equal highs. So this would be considered the buy-side liquidity, this green line. And it trades above the highs with failed displacement to then reject in the opposite direction. So what is failed displacement? Failed displacement is basically when you have a wick close above a high. When you have a wick close above the high, this is known as failed displacement. So when you have that wick close above that high, this is known as a buy-side liquidity sweep. But what makes it a buy-side liquidity sweep indefinitely? That's when you have failed displacement, which is above the high with a wick close. That's when the candle closes, but it's only showing the wick pushing past that high. Now, this is showing market makers manipulating retail traders into getting stopped out and then getting added liquidity to the market. So, whoever was going long here, they would have got stopped out. Whoever was going short here, they would have got stopped out. So they're getting stopped out on the short orders because their stop losses are above the highs usually, and they're getting stopped out on long orders because the market is going short now, which is adding liquidity to the market. Okay, so sweeping buy side can also indicate where the draw on liquidity is. Draw on liquidity, and make sure you write this down, draw on liquidity, or DOL, is basically what the market is targeting. Where does the market want to target? Where does the market want to take liquidity out? Where does the market want to fill liquidity? Draw on liquidity means the target of the market, whatever the market is targeting. Okay, so again, if we see this buy side liquidity sweep, we will see it as the market trading above it, having failed displacement, which is a wick close, and then trading in the opposite direction after. Sell side liquidity sweep. So a sell side liquidity sweep, also known as an SLS, is where the market trades below old lows and or equal lows with failed displacement to then reject in the opposite direction. This is showing market makers manipulating retail traders into getting stopped out and then getting added liquidity to the market. Sweeping sell side can also indicate to you where the draw on liquidity is. So just like the buy side, we are going to want to have failed displacement, which is a wick close below the lows this time. When we have a wick close, that means the candle closes with a wick coming over the low. This is known as failed displacement. And after we have that, this will be known as a sell side liquidity sweep to then reject higher. So just like a buy side liquidity sweep, we have failed displacement over a high to reject lower. We have a sell side liquidity sweep with failed displacement over the low to reject higher. Okay? So every time we have a sell side liquidity sweep, we are stopping out retail traders, or market makers are stopping out retail traders on shorts and on longs. Why on shorts? When you're going short, the market is actually going long. When you're going long, your stop losses, retail trader stop losses are usually below the low. So you're getting stopped out here going long, and you're getting stopped out here going short. Okay? And when retail traders get stopped out, that's added liquid funds to the market for market makers to move with their actual trade. So knowing these two things are going to happen, you can see how retail traders using support and resistance will get stopped out majority of the time. Compared to people who trade smart money concepts, they will know and have an edge over the market because they know what market makers are anticipating on doing, and we don't get manipulated into taking a long here, and we wait for this to happen to then take a long after. Okay? Or a short, you know. Now, we're going to be going over displacement and inducement. So I just talked about failed displacement. We're going to be talking about what displacement is, and then we're going to be talking about what inducement is, and how we can spot this and anticipate this on happening. Okay? So, displacement is an impulse in price to move up or down, which indicates that smart money is involved in the trade and can anticipate directional bias in the market. Inducement is getting tricked or manipulated into getting stopped out or making poor trading decisions. Knowing these two things will bring you into an advantage or edge over the market. Okay? So let's dissect this one by one. Okay? So displacement. Let's take the word smart money out of this first, and then let's dissect that first. Smart money refers to market maker money. So fuck you money is smart money. Okay? So market makers money is known as smart money. Whoever has smart money has fuck you money. Okay? Let's put it that way. Okay? So smart money is the people that have a lot of money. So like the billionaires, the millionaires, all those people, that's smart money. The hedge funds, big institutions, banks. So you think about a bank like Chase, right? You think about a bank like Capital One. Those people have fuck you money. The banks, the institutions, the hedge funds, right? All those people have fuck you money. And the people that have fuck you money are the people that manipulate retail traders into getting stopped out. But they take advantage of that by what the market algorithm creates. Okay? So let's dissect this. Displacement is an impulse in price to move up or down, which indicates that smart money is involved in the trade and can anticipate directional bias in the market. Okay? So, when we have displacement, that means, for example, if we are bearish, right? Look at this yellow candle. What does it look like? It's pretty fat, right? But what is it doing over this low? It's having a body close, the candle's body, it's closing over the low. Compared to when you look at a liquidity sweep, we are having a wick close over the low. So you look at a sell side liquidity sweep, you are having a wick close over the low. That is known as failed displacement. Right here, where you have a body close over the low, this is known as displacement. So displacement is having a body close over a low or over a high. Okay? Inducement is getting tricked or manipulated into getting stopped out or making poor trading decisions. So, manipulation is when market makers target retail traders to getting stopped out to then add liquidity to the market. Okay? And that's what retail traders fail to realize, is that market makers have manipulation. They manipulate traders to getting stopped out to then add liquidity to the market, right? Now, where does most retail traders have their stop losses and stop orders? Above old highs and equal highs, below old lows and equal lows. So market makers knowing this and what the algorithm is doing, building up engineered liquidity, they target these areas to then add more liquidity to the market, to then use this as their actual trade, adding more liquidity to their actual trade, if you see this. So market makers basically manipulate retail traders into getting stopped out or making poor trading decisions. Okay? So when you get induced into the market, you are getting manipulated or tricked into the market to getting either stopped out or making a terrible trading decision. Knowing these two things will bring you into an advantage or edge over the market. So basically, when you think about an edge, and you can ask any trader what an edge is, but I like to use this as a metaphor. When you think about like a samurai, and you think about like their katana or like their sword, right? Do you think that samurais or ninjas for example, right? You think when they use their sword, do you think that when they use their sword to kill somebody, do you think that they use a dull sword that's not sharp at all and just keep chopping chopping away at whatever enemy that they have to kill them. No, they want to use a super sharp sword that they can just slice through in one hit, right? So when you think about your edge is your personal way of looking at the market that you can have an advantage. So your edge is your advantage. When you think about your edge, you want to have an edge that'll have, you just need to hit the market once, and that's all. You don't want to keep hitting it and hitting it and hitting it, getting stopped out, getting stopped out, getting stopped out. You want to trade one time per day, hit TP, be done. That should be your edge. Your edge over the market should be the advantage of knowing what the market is going to do, what the market makers are going to do, what smart money is going to do, and taking advantage of that, and then waiting, finding your setup, finding your edge. Once you find that edge, have one clean hit through that trade, hit TP, be done for the day. You don't want to be trading 5-6 times a day. I don't even trade 5-6 times a day. I trade maximum 2 times a day. Maybe 3. That's if I'm feeling like really shitty, right? At most, I would trade 2 times a day though. You want to have your edge over the market being that one clean fucking trade. You don't want to keep hitting stop loss, hitting profit, hitting stop loss, hitting profit, losing 500, making 500, losing 500, making 500, losing 500, making 500, losing 500, losing 500, going back and forth, back and forth. What you want to do is, you can take losses here and there, lose 100, lose 100, lose 100 here and there, whatever. But when you win, oh boy, when you fucking win, lose 100, lose 100, lose 100, once you get a fucking banger, make 1,500, lose 100 here and there, lose 100 maybe 3 days in a row, boom, another 2,000. That's what I mean with your edge. You can lose, whatever. You can lose jack shit when you fucking lose. But when you fucking win, bro, let me tell you, you're gonna fucking bank. And that's the point of creating your edge. Your edge over the market should be multiplying your profits and be keeping your losses minimal. So knowing these two, displacement and knowing inducement, you can avoid getting stopped out, also known as avoiding your losses, and anticipating your wins. Okay? Okay, so a breakup structure, also known as a breaker market structure, so BOS or BMS, you can use either one, okay, refers to price creating higher highs in an uptrend and lower lows in a downtrend with displacement, which is what we just went over. This shows the willingness of direction and order flow in price. Having breaks of market structure can also indicate to you the direction of where the draw on liquidity will be. Okay, hold on. Okay, so breaks of structure or a break of market structure. So let's look at a bullish trend, right? An uptrend. This is creating higher highs. So a break of market structure, when you create higher highs, this is when you have the market pushing past the previous high, breaking past the previous high, but having displacement. Now, what is displacement? Remember, what is displacement? That's when we have a body close over a high in an uptrend and below a low in a downtrend, right? So this is a break of structure, is when you break past a high and then you have displacement over that high, which is a body close over the high. So every time you have a body close over that high, that is known as a break of market structure. Okay? Obvious, when you have a low and you break past that low, when you get displacement over that low, that is known as a break of market structure as well, just in a bearish order flow sense, other known as a downtrend, right? Okay? So again, a break of structure or a break of market structure is when you push past the high having displacement over it, which is a body close, or pushing past below a low with displacement over it. Okay? Now, this is pretty much combining, in my opinion, this is combining a liquidity sweep with a break of structure. kind of combining it together, if you can see that. Okay, so market structure shifts, or an MSS. A market structure shift is when the market has a shift in direction, showing signs of a reversal bound to come. This is created, so in a bullish example, so look at the right example. In a bullish example, price creates a low, high, lower low, higher high. So again, low, high, lower low, higher high. In a bearish example, so it created in a bearish example, look at the left example now. Look at the left model. Price creates, let me fix that, sorry. Price creates a high, low, higher high, lower low, okay? Seeing this is an indication of reversal occurring and the willingness of order flow. So when you see, for example, we're in an uptrend, right? Creating higher highs, higher lows, and you eventually come to the point of creating this market structure shift. When you create this market structure shift, you are having a break of structure to the upside. But wait, what happens? You have failed displacement. So it's not a break of structure anymore. This is known as a liquidity sweep, a buy-side liquidity sweep. To then reject lower, you have that sweep, you reject lower, having displacement over that low. So you're going uptrend, having breaks of market structure to the upside. Then you have a final failed displacement right here to then have a break of structure to the downside, having displacement over that low. That first break of structure that's in the opposite direction will be known as a market structure shift. You're shifting market structure. You're having bullish breaks of structure to then switch to having bearish breaks of structure. So going from bullish breaks of structure, once you get that first bearish break of structure, that is known as a market structure shift. Opposite with a bullish market structure shift, when you are being bearish, having bearish order flow to then switch to having bullish order flow. When you're having bearish breaks of structure, once you have that first bullish break of structure, after having bearish breaks of structure, that first bullish break of structure will be known as your market structure shift. Okay? And seeing the market structure shift happen, this can anticipate a trade setup occurring because you can catch your edge over the market by seeing that a reversal is about to come. Okay? So knowing breaks of structure, knowing market structure shifts, this is important to having your edge over the market. Okay? Now, we're going to be going over the very, very pinnacle of advanced market structure. Okay? So, short-term highs and short-term lows. This refers to a few or more candles that form highest or lowest candle of the bunch. These are used to find pools of liquidity, anticipate stop hunts, and see breaks and or shifts in market structure to be formed. Okay? So when you look at short-term highs and short-term lows, this is meaning you have a few. Now what I mean by a few is I mean at least 3 or more. So you look at this. You have a short-term low. Boom, 1, 2, 3. The lowest point in those 3 candles is going to be your short-term low. Boom, 1, 2, 3. 1, 2, 3. This will be your short-term high right here. Boom. 1, 2, 3, 4, 5, 6. Whatever. This will be your short-term low. 1, 2, 3. Short-term low. Okay? Boom right here. 1, 2, 3, 4, 5. Short-term low. 1, 2, 3. Short-term high. Okay? So going back and forth. And these will be used on lower time frames. Okay? So the highs and lows that are not so obvious, that will be basically your short-term highs and short-term lows. Okay? Advanced market structure with intermediate term highs and intermediate term lows. So ITLs and ITH. This is where short-term highs and lows reside to the left and right of it. The intermediate term high must be higher than the short-term high on the left and right. The intermediate term low must be lower than the short-term lows on the left and the right. Okay, so we look at the left example. Okay, let's look at the left example. Your intermediate term high will be this middle, or your intermediate term low, will be this low right in the middle. Like I said, the intermediate term low must be lower than the short-term lows on the left and right. So these two short-term lows on the left and the right, this will create an intermediate term high. So if you have an order like this, and a lot of retail traders see this as head and shoulders, right? So they'll see this as a head and shoulders pattern. And you can look this up. This is where you have a short-term high, an intermediate term high, and a short-term low. Or sorry, you'll have a short-term low, an intermediate term low, and a short-term low. Okay? So you have two short-term lows and an intermediate term low. Retailers would see this pattern and they'll want to be trading long. That's what the pattern is. It's a long pattern. But in reality, it's actually going to be coming down lower, because when we learned about buy side and sell side liquidity, we have an old low here, which the market wants to target to then take out. So instead of the market trading long, market's going to actually trade short. So intermediate term highs and intermediate term lows are basically the lows and highs that you want to be targeting as buy side and sell side liquidity. All the short-term highs and short-term lows, they'll just be added liquidity basically that are going to be targeted or taken out. Same thing here in a candle format. You see how the intermediate term low is lower than the short-term lows on the left and right. Okay. Now, when you look at intermediate term lows, this will be an indication of, also known as liquidity. So like sell side, buy side, and sell side. This can also be an indication of a market structure shift, a break of market structure, any of those. Okay. So you want to be targeting intermediate term lows and intermediate term highs as buy side and sell side. The short term highs and short term lows, they'll just be acted as added liquidity basically. So you want to be focusing on the intermediate term lows and intermediate term highs as targets of liquidity. Okay? And finally, we're going to be going over long-term highs and long-term lows. So long-term highs and long-term lows is a high or low surrounded by an intermediate term high or low on the left and right side of the long-term high or low. The long-term high must be higher than the intermediate term high on the left and right of it. The long-term low must be lower than the intermediate term low on the left and right of it. Any long-term high or low can be seen as some type of time-based liquidity. So time-based liquidity is known as a session high or low, a previous day high or low, previous week high or low, previous month high or low, and previous year high and low. Long-term highs and long-term lows can be seen as higher time frame liquidity points, other known as POIs, which is a point of interest, or a PD array that it is interacting with, which is what we would go over in another video. Okay? So, I know that you guys might be confused, but I need you guys to write this down. Okay? So if you guys need to pause the video on any of these slides, make sure you pause it, write it down. Okay? While I'm explaining it to you guys. So let's dissect this down. Long-term highs are going to be the most confusing for people. Okay? So long-term highs is surrounded by intermediate term highs and lows on the left and right. So you look at this right here, this low right here. Look at the left example. This long-term low right here. This long-term low right here. It is tapping into a higher time frame PD array, which is this 4-hour order block. Now I'm not discussing PD arrays in this video, but I'm just letting you guys know. It's tapping into this 4-hour PD array, which is an order block. This low here is going to be our long-term low. On the left and on the right of it, we have our intermediate term lows. Intermediate term low here, intermediate term low here. And they are higher than our long-term low. Okay? So our long-term low is higher or lower than our intermediate term lows. Okay? Same thing with our long-term high. We have our intermediate term high on the right and intermediate term high on the left, leaving our long-term high in the middle, which is also tapping into our higher time frame for value gap, which is a higher time frame PD array. Okay? So our long-term high is always going to be higher than our intermediate term highs on the left and the right. Okay? And this will be known as our higher time frame or liquidity. or our time-based liquidity. And this can be a previous session high or low, previous day high or low, previous week high or low, previous month high or low, and previous year high or low. So whenever markets are targeting overall, so on the higher time frames, whenever they are targeting liquidity, buy side and sell side liquidity on the higher time frames, they are looking at long-term highs and lows. Okay? When we're looking at on an intraday basis, so on a daily basis, we are looking at intermediate term highs and lows. On a lower time frame basis, we are going to be targeting short-term highs and lows. Okay? But overall, when we are trading, our main focus should be intermediate term highs and lows. Okay? So, I hope you guys took notes. We went over basic to intermediate to advanced market structure. I did dissect each and every one of them down. I don't expect you guys to know this right away. I do, however, expect you guys to have taken these notes down. And I do expect you guys to go over them with your own eyes, whatever your notes that you wrote down, go over it. Also, look at the pictures that I showed you guys in this mentorship video. And also, I'm going to have some homework for you guys. Oh, yeah, love fucking homework. Yeah, this homework's going to learn for you guys. It's going to teach you guys to eventually how to make money with this. So this isn't homework to not use in the future. This is homework that's going to benefit you. So this is going to benefit you. I'm giving you guys the sauce. It depends if you want to cook with it or not. Okay? So, look at this. This is your homework. In the market, okay? So this is your homework. In the market, and this should be every night, 5 days a week. 5 days a week, I want you to do this. I want you to go back in time, okay? Go in the market. Go to any time frame. Go on the daily. Go on the 5 minute. Go on the 1 hour. I don't care. I want you to find at least 3 examples of advanced market structure. That can be an intermediate term high, long term high, short term high, intermediate term low, long term low, short term low. It can be any of those. It can be a break of market structure. It can be a market structure shift. It can be displacement. It can be inducement, which is, having engineered liquidity being formed. Spotting engineered liquidity. That can be one. Spotting sell-side liquidity. Spotting a sell-side liquidity sweep. Spotting buy-side. Spotting a buy-side liquidity sweep. It can be any of these. Okay? That will be your homework. I want you to find 3 of these. 3 of these concepts. And not 3 of the same concepts. 3 of each different concepts. Okay? What I mean by that is not saying 3 of advanced or 3 of intermediate term, 3 of long term, 3 of short term. No, I mean at least 1 of a different one. So at least 1 of, at least 3 in total. So what I mean by that is like 1 market structure shift, 1 intermediate term high, 1 sell side liquidity sweep. And then you're done. You can do more if you want. It's going to benefit you if you do more. But that should be the minimum for your homework tonight. Okay? At least find that. Once you do that, you're going to do the same thing the next day. The same thing the next day. And the same thing the next day. Until you're able to figure out what they look like. And if you feel like you don't know what it looks like, refer back to this video or refer back to your notes. Okay? Other than that, this has been going over basic to advanced market structure. And the more you get familiar with this, the more you are going to be able to find this and spot these things in the market without me showing it to you guys. Okay? Other than that, I hope you guys have a good rest of your day. And I will see you guys in the next episode of the Pip Catchers mentorship. Okay? And I hope you guys can identify at least some of these concepts in the live markets. So, I'll see you guys in the next Pip Catchers Expedition mentorship. And I wish you guys good luck. And I hope you guys have a good rest of your guys' day.